Hello, everyone, and welcome to this Family Building Society podcast all about joint borrower sole proprietor mortgages. JBSP products are designed to help family members support each other with affordability when applying for a mortgage. Up to 4 incomes can be used for affordability, as up to 2 borrowers who will own and occupy the property can be helped by up to 2 supporting borrowers. All borrowers are liable for the loan repayments and will be on the mortgage deed, but only the borrowers living in the property will be on the property title. It is typically done with direct family members, but the mortgage landscape is becoming more diverse, with wider family members now assisting. It is also not just the older generation helping the younger generation, but it is now being used in reverse, so children can help their parents with mortgages in later life. With affordability a key concern for many borrowers, this is a growing area of interest to lenders not in the space, and current lenders are looking to innovate and develop this segment even more. Family Building Society is synonymous with this space, and I'm delighted to be joined by Grace Bennett, BDM for the West N25, and Paul Roberts, Senior Account Director, who will talk about Family Building Society's offering and key trends that brokers should be looking out for. Thank you so much for joining me. So we're going to kick off covering the basics, really. So what are the kind of common cases that you see, and who is this aimed at? Who's the typical borrower for Joint Borrower Sole Proprietor?
Hi, Anna. So yes, for me, personally up here in the north of England, the vast majority of the cases I see tend to be parents helping children, but there is a significant proportion where it's the reverse effectively, and we obviously help both of those. It tends to be two parents helping two, I want to say siblings, or their wives, partners, etc. You'll often find it'll be situations where they're perhaps going through a divorce or a separation, and so they're needing some additional affordability to help with that. But on the flip side, it tends to be where parents have perhaps come to the end of the term of their traditional mortgage, want to stay in their home, but perhaps have moved on to pension income rather than earned income, and that might not be quite sufficient to help them get them over this line at this moment in time. So the kids are helping them.
Grace, does that echo what you see? Obviously, because you cover a different area.
Absolutely. Exactly as Paul said, those first-time buyers looking to get onto the property ladder that need that additional support from family members. As Paul said, whether wanting to buy out another party and whether that's an ex-partner. And that reverse way as well. And it's not just restricted to purchases either. We see clients, as I said, remortgage as well. And it might also be that they need to do some essential home improvements to the properties. We do see that as well.
Yeah, it really helps boost affordability. But what are the other main advantages of this kind of product?
It's really designed, and the main advantage in my eyes is to help for stamp duty fees. So the great thing about Joint Borrower Sole Proprietor is that family members can help that main applicant come on from an affordability perspective, but they're not on the title deed, so there's no stamp duty fees for them. So I would say that is our biggest advantage there for this particular product.
Paul, would you echo what Grace has said, or do you have anything you would like to add to that as well?
No, absolutely. It's what Grace is saying. It effectively, Joint Borrower Sole Proprietor is an enhanced version of the old guarantor mortgage. It just allows more flexibility, and also from a lender's perspective, it just gives them a little bit of additional security.
Obviously, this is a little bit more challenging to underwrite because you have more parties involved. So what would you say are the main challenges with underwriting this kind of deal, and what should brokers do to ensure their cases progress as smoothly as possible?
So certainly the main challenges tend to be age, Anna, and that's one of the reasons why Family Builder Society is so popular in this market. You'll often find lenders are restricting or are restricted by the age that they will lend to somebody until. With family, we can still do, for example, a 70-year-old applicant helping their son or daughter, for argument's sake, they can still potentially do up to a 25-year capital and interest mortgage. And when that is a big challenge for underwriting, because it affects the affordability significantly. And if a lender's only able to offer 80 or 85 years, that extra 10 years for the applicant can make a huge amount of difference. In terms of making sure the case goes smoothly, it's the old adage, make sure you give us all the information up front, make sure you package it properly. We want the bank statements, the income verification, etc. on there. And I will say that always the main challenge for underwriting any case is getting that documentation in first time.
Grace, do you have anything to add to that? Anything you would recommend brokers so that brokers could get in line before they submit their cases?
Personally, when I'm speaking to brokers, a lot of the time we do hear that joint borrower sole proprietor is really complicated product. It's complicated from the underwriting process and the submission of the application. But actually, if you do look at it, it's no different to a joint application, whether that's for 3 applicants or for 4 applicants. Yes, it is a little bit more work, but as Paul said, if you are packaging the case with all of the submission documents and providing clear information with the application, it's going to make it easier for the underwriter to process. We are a manual underwriting lender. So with that, the broker doesn't need to worry about putting additional notes and, having a robot become confused. It is that the application is looked at by a human underwriter. They will go through their notes and it will help them understand the client's needs and their story better, which, with that, it makes it a smoother application process and an underwriting process for that matter as well. You know, me as a BDM, and that's for all of our BDMs, and Paul being a senior account director, we also pre-qualify your clients' cases as well. So we do the AIP, we can check that affordability as well from the outset. And we're there to support the mortgage application through to completion as well. So I think with all of that, it should be nice and straightforward, I'd like to think, for you.
And Paul, I wanted to bring something up that you mentioned about age actually being that age being a barrier. Do you think that other lenders, Family does a really good job of widening that and having the criteria you mentioned in place? That do you think that other lenders might be looking to increase the maximum age? Do you think they'd follow Family Building Society's lead on that?
I think if you look at the building sector as a whole, and certainly the smaller building society sector, we are very switched on to older, later life lending effectively, which Joint Borrower Sole Proprietor will just fall under for part of it. I think the biggest issue for the high street tends to be it's their credit score driven model. And the older an applicant gets, perhaps the less credit they've got, it's pension income. They don't look at it quite the same way. They may do in the future, but as it stands at this moment in time, certainly the smaller mutual modern building society sector looks at this in a far more perhaps sensitive way to help those clients, and that's the biggest difference for me.
That is something I'm hearing from lenders, especially from building societies. They're always looking at their criteria and always looking at how they can better support customers. Not that other lenders don't. I just notice it a lot with building societies. As Grace said, because of that manual underwriting approach as well, that feeds quite well into that. Something that Family Building Society has been doing over the past year is in looking at looking at its criteria. So you've increased the LTV at certain loan sizes and you've increased the total loan size. I'm just wondering if you could go into that in a little bit more detail about why you decided to make those changes.
I think we can all appreciate how difficult it is getting onto the property ladder, and especially, being the average age for a first-time buyer are those in their 30s. I think adapting that criteria and making it more flexible from the point of view of loan to values and loan sizes just it enhances our product even further. It makes it better for those first time buyers. We want to be as flexible as possible. So I think, with everything that Paul was saying with those older family members coming on and giving them a longer term into retirement, it just felt sort of perfect to lower that deposit amount that we require.
Paul, do you have anything to add to that as well?
Grace is perfectly correct. And the simple fact that we've moved to 90% loan to value very recently, we're already seeing that go down very well in the marketplace and applications coming in because it's that smaller deposit. 95% lending, you're even seeing 100% lending coming back into the marketplace. But that still means that the client needs that affordability. They might not meet that affordability in their own right. So being able to offer joint borrower or sole proprietor now up to 90% should make a real difference for a lot of applicants.
Another change you guys made was expanding the people that can be on the mortgage to wider family members. And what was the reasoning behind that move, and what has the reception been like so far from brokers?
It's been great. It fits in line with what we stand for as a lender. We're very much in that later life lending space. So it felt appropriate to widen that gap to other family members as well. It's rare, we don't see it all the time, but you can have grandparents come on and help. It's not just the bank of mum and dad anymore. It is the bank of family. So widening that, the family members that can help, it just seemed perfect for what we stand for as a lender. And taking it to age 95, it means it's nice and affordable for them still as well. So that was really the main reason for that, but it has been very well received.
Paul, with the wider family members, I know you said it's not necessarily very commonly brought up, but it's good to have that. It's good to have that option. Are you seeing more applications coming through, looking at the bank of family, as it were? Using those wider family members.
Yes, because we're seeing brothers and sisters help their own. You're seeing grandparents doing it, and it's just a reminder that the reason the terms that we offer are so old is about the affordability. At the end of the day, Joint Borrower Sole Proprietor is ideally suited to people who will, in 5, 6, 7 years' time, be able to afford the mortgage in their own right if it's for the younger borrower. But it's the monthly payment today that makes the difference. And whilst families sometimes might be slightly more expensive on an interest rate than a high street lender, the term that we're offering will make such a difference to that affordability on a day-to-day basis. And so that's why the terms and who we will allow, so grandparents being on there as well potentially, does make a difference.
I've seen, for instance, NatWest recently come out with its family-backed mortgage, and one of the criteria is to allow friends onto the mortgage as well. Is that something Family Building Society also offers, or is that something you're seeing more demand for?
I'm not specifically seeing any specific demand for it. I know there are other building societies, perhaps the bigger ones, there's one or two that will consider outside the family scenario. I think just from a risk perspective as a business, has to be very carefully considered if they're not related to the individual. So I don't think that's one we would consider just at the moment, but this is an ever expanding product. We were at just parents to start with. We gradually will open it out, and if we can do, you can guarantee that we'll look at trying to do something.
Yeah, it is an interesting criteria to include. Like you said, that family aspect adds a layer of security. But I just thought it was quite a novel criteria for a high street lender to look at. Um, are you seeing more brokers approaching you who may not have used this product before, or who may not be as familiar with it? Do you see broker interest in this product growing?
Absolutely. I think as a smaller building society, we do find that we come across brokers who have never used it before, and they found us due to our proposition, on Joint Borrower Sole Proprietor, and also just for later life lending for that matter as well. We do class ourselves as that intergenerational lender, and it's different ways of exploring that and how we can help first time buyers and all those clients looking to get onto the property ladder. So yeah, I would say we see new brokers, existing brokers, all keen to want to learn more about this product that we can offer.
Paul, do you have anything do you have anything else to add? Being based up in the north, are you seeing more brokers looking at this product, or growing awareness of this product?
At the end of the day, now that 80% of the market is generally speaking swallowed up by the high street because it's straightforward business. Advisors, brokers, they're constantly educating themselves. And I was at an event only this week where we're talking about specialist lending. And joint borrower is one of those things that's coming up. Later in life is one of those things coming up, so that brokers are trying to educate themselves about these new and innovative ideas that are out there to try and help their clients. And I think that if there's one thing I would say straight away from this podcast today is keep educating yourself, because there are things out there that little lenders, smaller lenders like ourselves, who just will keep adapting and add value to you as a broker and your clients.
Grace, if you wanted a broker to take one thing away from this podcast today, what would it be? I know Paul has mentioned education and brokers educating themselves. Do you have anything to add to that?
Yeah, I'll just reiterate what I said earlier about having that access as your BDM. Really use us. We're there to make your life easier and to find that perfect solution for your client. So I think, yeah, alongside what Paul was saying about educating yourself and staying educated with these new products and how they're developing over time. But yeah, absolutely. Use your point of contact at your lenders. They're there to help you.
Yeah, I think you make a good point about the BDM support. Family Building Society has a lot of BDMs, comparative to its size. There is a lot of support available, and that support is national, isn't it? There are BDMs that cover all the regions.
That's right. Yeah.
And we have telephone as well, Anna, as well. We've got a telephone coverage for the areas that we don't have physical presence.
That's all we have time for, unfortunately, for this episode. But tune in for our next episode where we dive into reverse joint borrower sole proprietor and then also look more into the bank of family. So I hope you can join us again for future episodes.